Assalamualaikum warahmatullahi wabarakatuh and good day everyone. My name is Diram Muhammad Sudana, matric number 261208. Today our group 2 will present about topic 4, performance measurement, starting with me here with the models of performance management. Now to the first one, is it performance measurement or performance management? Performance measurement, to put it in simple terms, is the procedure of gauging how the progress towards the intended goal is. Like how has it been going for the business? Has it been satisfactory? And how did it do? Usually, the profit-based performances metrics are used here, and it is actually a good way to measure things. But alas, this may not be enough for now, since profit-based metrics only measure past performances and is ever changing based on how accounting policy changes. This will lead manager to pursue greater number in the metric instead of looking at prospects and future strategy, making their decisions good on the short-term based when they will sacrifice future prospects for a better look today. With the measurement being done, the next is the management. Performance management is the usage of information gained from the previous measurement for the betterment of the organization. From prior measurement, management can help to set the goals based on the result. This can be done in many ways, like allocating excess funding to a more important resources, confirming on whether or not they will change the program they had based on the result, and of course to see whether the result of the performance is satisfactory or not, and to decide whether or not decisions they will take next. Now the next one moving up is the performance management model. Here we have the building block model from Fitzgerald and Moon from 1996. As per what I've said before, many companies nowadays not only engage in financial competition. Now this building block take that into consideration and put it another to create it another two dimension, which are result or target and determinants. The outcome of management previous decision and activities can be referred as result or targets. These are reflected in the model's first two dimensions, which is financial performances and competitiveness. It could also be setting the new targets for the newest measurement like ownership, achievability, and equity. And while the word determinant refers to the model's forward-looking dimensions, which aspect of future performances are most essential for a company to achieve a favorable financial and competitive outcomes. Future success will be determined by quality, innovation, adaptability, and resource use. After discussing what is financial performances and measures as well as its building block model, I will now go through the present measurement system weaknesses, starting with how measurements are not aligned or tuned with the strategic goals. All business entities always have a goal in mind, whether it's financial or other kind of objective. This financial measure will try to gauge how much of the goal can be achieved after a set period of time, and the usual result will be changing the policies or whether or not it's going well to set another goal in mind, which is not how such a goal is intended. Next up is how the customer are not related at all with the measurement processes. These measurement processes are purely done from the inside and is not taking any consideration of how it will affect the relationship with customers. Next up is how the financial metrics are too late to make any changes and they foster a short-term mindset. These measurements are taken after a set period of time after the business is running on its course. Often, even after a critical problem has been identified, not many changes can be made. Not many that is actually impactful, at least. Because of this, managers will resort on how to they will think hard on how to fix this problem that they have at hand with limited time, opting and building their mindset to focus only what it is at hand and not what the future could be. Next up is the fact that a lot of important non-financial performance metrics are overlooked. With focusing on how to fix their problems at hand, the other important non-financial performance metric is not investigated at all. And lastly, but not least, is the fact that measurements are frequently employed to punish rather than to teach. This misuse is usually used as the way to blame someone. Instead of figuring things out and creating a better future, this measurement, some people choose to pin these unsatisfactory findings in their measurement to someone and force them to deal with it. Once again, forcing them to think on whatever they can do to fix the problem at hand and opting and not focusing on how to create a better future opportunity instead.
Assalamualaikum warahmatullahi wabarakatuh. My name is Fatiha Nadra binti Mansur, metric number 273279. I just want to highlight about the financial performance measurement and non-financial performance measurement as well as balance scorecard. For your information, financial performance measurement is a subjective measure of how well a company can use their asset to generate revenue. For example, a financial performance indicator is the return on asset, return on equity, economic value added, earning per share, and many more. Before using contemporary indicator, traditional indicator is being implemented, but there are a few criticisms towards this indicator. First is time lag of preparation to use. This is inappropriate for management accounting, which requires timely data in order to make decisions. Second is using historical data to make future plans, decision making. This is inappropriate because comparisons over time are impossible. Also, non-current asset is quickly out of date. Third is tendency to rely on short-term views, not as modern contemporary tools, which often focus on the future. Last is qualitative information cannot be obtained. These tools not able to interpret how successfully the company will be in the future. But the modern contemporary tools such as economic value added can be seen in wider information to enhance the performance of a business. Next is non-financial indicator. The indicator means other measure that is used to achieve the strategy objective and it does not express as monetary value. For example, is customer satisfaction, which the satisfaction is based on the survey with the few questions and few respondents. Other example is on-time delivery. This is the performance indicator to measure the deliveries of finished products made in time. Other examples also are non-financial indicators such as new customer development and product or service quality. There are a few benefits of non-financial indicator. First, it can give better feedback on how to meet strategy objectives. So, organizations are able to see more exactly on what they need to do to hit their goals. Second, it can be more accurate to measure operation because financial indicators don't always provide the full story. Third, it can be easier to link the certain aspect of organization's overall strategy. More specifically, most organizations don't all have finance based on the mission statement. If the mission is to provide the best customer service in industry, customer satisfaction is more suitable indicator. Next is balance scorecard. Balance scorecard is performance metric used to identify, improve, and control a business in various functions. It measures past performance data and provide the organizations with feedback on how to make better decisions. The concept of balanced scorecard introduced in 1992 by Norton and Kaplan. Balanced scorecard involves four main aspects. First, learning and growth. Learning and growth is the training is to analyze through investigation of training and knowledge resources. For example, employee turnover or hour of training. Is internal business process. Internal business process is to investigate how well products are manufactured. It can be used to track any gaps, delay, and shortage or waste. For example, on-time deliveries, quality cost, setup time. Next is customer, which is to measure customer satisfaction with the quality on price. The customer will provide the feedback on the products or the services. Last is finance. Finance is to understand the financial performance such as return on asset, return on equity, economic value added, earning per share. One of the most powerful elements in balanced scorecard is strategy map. Strategy map is to guide the organizations to objectives. As the information is contained in one page, so it must be very easy in strategic communication. There are four perspectives. First, financial, second, customer, third, internal business process, and last, learning and growth. This strategy map has cause and effect relationship that are described by the connecting arrow. The argument is that succeeding objective from learning and growth that will affect to the internal business process, then will turn to the customer's perspective, and then finally will affect the finance perspective. There are a few benefits of strategy maps. First, it can be a better alignment of projects and initiatives. The balanced scorecard help organizations map their project and initiatives to the different strategy objectives, which to ensure the project tightly focus on delivering the most strategy objectives. Second, it will make a communication easier. Communication across the team member and department become easier when everyone having a streamlined performance measurement system. Third, it can connect the individual worker to organizational goals. Individual worker may find it helps their own performance when they can see the greatest purpose behind the goal when they aiming to hit. Last, it can improve the measurement and the reporting because it can help organizations design more effective report.
A very good afternoon to doctor. My name is Tana Shakuntala Devi and my metric number is 272745. Now I'm going to present measuring customer performance part. There are few ways when considering how to assess customer service at a company. It might also become apparent that focusing on just one area at a time will leave major blind spots. For instance, how many customer inquiries can a team accommodate each day? The number might be high, but if you're leaving hundreds of customers unhappy at the end of each interaction, that's not exactly a sign of success. So, it's important to find out within that volume how satisfied each customer really is with the support they are receiving. Following a few customer perspective measure. Number one, customer profitability analysis. The reporting and analysis of customers' earned revenues. Number two, average resolution time helps to find the performance stacks up. Number three, customer service abandonment rates. Divide the number of abandoned customer service by the total number. Number four, customer effort score tracks a customer's effort toward resolving an issue. Performance management. Service organization usually focuses on providing a specific type of service as its primary mission or objective. Example, healthcare, universities, municipal governments, policies, banks, hotels, auditing and accounting firms, legal firms, among others. There are four differences between service and manufacturing organization. First one is manufacturing organization provide tangible product whereas service provide intangible. The implications are service are difficult to describe, exhibit or communicate. The second one is manufacturing easy to standardize while service heterogeneous difficult to standardize. Implication guaranteeing a standard experience the customer is problematic. Final implementation of the strategy is dependent on employees. Quality service delivery is always partly personality dependent. The third one is production and consumption occurs separately in manufacturing, whereas in service, simultaneous production and consumption occurs. The implications are customers cannot test drive a service. Service are higher risk purchases for customers. Both customers and employees participate and affect the service outcome. So there are parts of a service always needs to be decentralized close to the customers. The fourth one is durable for manufacturing, whereas service are perishable. Service cannot be kept in a stock. Input processes output model in the service organization. Under input, there are human resources, customers, and other resources. Under process, there are inbound logistic, operations, outbound logistic, marketing and sales, after sales service, and under output, human resources, customers, other resources. Fitzgerald proposes the results and determinants framework as a performance management system for service companies. Framework contains the following: flexibility, competitive advantage, resources utilization, financial performance, innovation, and quality of service. Performance evaluation for service organization. Under performance dimension, the first one, competitiveness. For the type of measures, relative market share and position, sales growth, and measures customer base. Second one is financial performance. Type of measures are profitability, liquidity, capital structure, market ratios, and etc. For third, quality of service. The type of measures are reliability, responsive appearance, cleanliness, comfort, friendliness, communication, courtesy, competence, access, availability, security, and etc. For the fourth, flexibility. Type of measures, volume flexibility, specification, and speed of delivery flexibility. Fifth one, resources utilization. The type of measures, productivity, efficiency, and etc. Sixth one is innovation. Type of measure, performance of the innovation process, performance of individual innovations, and etc. 4.4.2 Non-profit organization. 4.4.2 Non-profit organization. The World Bank defines NPO as private organizations that pursue activities to relieve suffering, promote the interests of the poor, protect the environment, provide basic social services, or undertake the community development. NPOs perform a variety of service and humanitarian functions, bring citizen consent to government, advocate and monitor policies, and encourage political participation through provision of information. The fundamental features of the NPO are: they exist to fulfill a charitable purpose, they function without the use of coercion, they promote without distributing profits to stakeholders, they exist without simple and clear lines of ownership and accountability. One of the most difficult issues regarding NPOs is the management of stakeholders. The various stakeholders in the NPOs have different expectations, and this situation affects how they judge and attribute trust and creditability. In this sense, the definition of performance indicators can be profoundly influenced by stakeholders' requirements and sometimes not express the exact measure of interest to managers, which make it difficult to define the criteria for performance measurement, meaning that output or outcome in the NPOs will be different due to the different stakeholders' objectives.
Good day, doctor. My name is Pravindran Analaki Ravi and my metric number is 272625. Now I am going to present about incentive and compensation system. They are divided into two, which are monetary incentives and non-monetary incentive. This incentive and compensation may bring temporary effects. Motivation based on this incentive and compensation lead to less interest, value, and effort toward achievements. First, we look into monetary incentive. Compensation refer to those financial return in cash or shares that employees receive directly from their employers as part of their contractual relationship. It can be fixed, which is base pay, and can be variable, which is short and long-term incentive. Base pay or basic pay is a compulsory for employer to pay to their employees. It refers to the minimum amount that an employee receives for working for an organization. There are many ways to compute basic pay. The employees may receive an hourly wage and gets paid out for hours worked. Other employees get a salary or net amount of pay per month, twice monthly, bi-weekly, or per year. no matter how many hours they work. Basic pay of basic salary reflect the value of the job or the person performing the job. There is also a situation where the employees work on a commission basis and may only receive money if they sell product and services. Next, variable pay is employee compensation that changes. It can be incentive and bonuses. It is often used by company to recognize and reward the employee achievement and contribution toward productivity, profitability, safety or some other measure viewed as important by the top management. Incentives are based on predetermined performance goals and must be re-earned each performance period. Organization can award short-term and long-term incentives to their employees. Short-term incentives are normally in the form of cash and determined as a percentage of base pay. Long-term incentive can be either in cash or paid in equity such as stock option. Bonuses are one-off payments that are also subject to individual, group or organizational performance, but they are given after management evaluate the performance. A bonus is non-guaranteed and one-off payment that will be given to the employee after their performance has been evaluated by the management. An incentive is a plan which is forward-looking. Payment is tied to the achievement of specific objectives that have been predetermined and communicated to the employee that are on the plan. Example of popular variable pay rewards including performance-related pay, profit sharing, gain sharing, peer incentive, company pay trip, holiday bonus, deferred compensation, defined benefit pension scheme, and allowance. Now we look into non-monetary incentive. Benefits are non-cash or services that employees receive in exchange or from their employment relationship. Some benefits are provided indirectly by the employer through the service provided such as insurance companies. Benefit in kinds include items such as health insurance, medical coverage, SOCSOS injury scheme, employment coverage, meal voucher, work from home voucher, professional trainings, leave for medical, maternity or unpaid, education assistance and company car. The advantage of benefits in kind is that greater flexibility can be given in designing a reward scheme for an individual. The purpose of this benefit is mainly to help retain employees in the long term by providing them with a certain level of security related to their health, welfare, retirement, and time off. Recognition is also a non-monetary rewards given to the employees as a formal acknowledgement for exemplary performance, special behaviors, or length of services. However, some companies may also give cash as a way to recognize their employees. Example of recognition is gifts, prizes, trips, and thank you note. Essentially, the goal of employee recognition is to reinforce particular behaviors, practices, or activities that result in a better performance and positive business result in order to motivate the employee and improve their morale. In addition, the benefit of recognition are able to make employee happier, improve their employee retention, cultivate a culture of self-improvement, and boost employer morale.
Good day everyone. My name is Lavanya Dr. Banu and my metric number is 273203. Now I'm going to explain regarding the reward systems. Firstly, let's see about the effective performance. What does an effective performance do? Effective performance will ensure that individual and team goals are aligned with organization goals so that performance at both the individual, team, and organizational level are enhanced through effective implementation of human resource management practices. When an organization has effective performance, it will naturally lead to have a good reward system. Okay, how to implement an effective performance management system? The best systems go beyond formal ratings and focus on 4 key aspects. First one is enable employees to grow and develop their talents. Secondly, improve communication between employees and managers. Thirdly, align individual work to achieve organizational goals. And the fourth is enable individual and teams to perform at their highest potential. Now, let's see the recommendations for an effective performance management system. First one is we can set goals that have frequent short-term objectives that are challenging and have meaning. Second one is to develop manager coaching skills so that feedback is accepted by employees and improves performance. Third one, in monitoring performance, educate management on how to provide employee performance feedback that is ongoing in the context of work rather than outside of work. And lastly, we can eliminate the self-assessments and reduce paperwork. However, it is probably best to still include self-assessment as this allows employees to have voice. Now, let me explain the second subtopic of reward system, which is measurement and reward system. What is reward system? Reward system is considered as an incentives for managers. The main purpose of reward system is to motivate superior performance among managers and employees to achieve their organization's goals. It also to motivate managers who do not provide good services due to the reasons like low ability, prefer not to work hard, and prefer to spend company resources. Frequently, managerial rewards include incentives tied to performance. The objective of managerial rewards is to encourage goal congruence so that managers will act in the best interest of the company. When controls can motivate behavior that is organizationally desirable, they are described as encouraging goal congruence. And the managerial rewards can be in the form of monetary and also non-monetary. For example, salary increases, bonuses based on reported income, stock options, and recognition. Now, I will explain on how to tie reward to performance effectively. The first way is by ensuring that employees understand how their jobs contribute to achieve organizational goals. Secondly, by ensuring employees understand and trust the reward system. Thirdly, by ensuring employees believe that it measures what they can control. Fourthly, employee must perceive the reward system as fair and predictable. The fifth way is if the reward system does not measure performance that is under the manager's control, they may ignore the measured performance because it is independent of their efforts and the reward system will be ineffective. The sixth way is the designers of the PMS must make a careful choice about whether it measures employees' inputs or outputs. Generally, the greatest alignment between employees and the organization's interests is when the PMS monitors and rewards employee outputs that contribute to the organization's success. However, sometimes outputs are beyond employees' control. So in this case, company choose to monitor and reward inputs, for example, employee learning, demonstrated skill, and time worked. Seventh way is the elements of performance that a PMS monitors and rewards should reflect the organization's critical success factors. This is done so that the PMS is relevant and motivates intended performance that matters to the organization's success. PMS must consider all facts of performance so that the employees do not sacrifice performance on an unmeasured elements for performance on an element that the reward system measures. The eighth way is the reward system must set clear standards for performance that employees accept. Standards will help employees assess whether their skills and efforts create results that the PMS captures and reports as outcomes. The measurement system must be standardized so that it can accurately assess performance. This is the 9th way. And the 10th way is the PMS establish clear relationship between performance and outcome. The last way is when it's critical that employees coordinate decision making and other activities with other employees. The reward system should reward group rather than individual performance. Many organizations now believe that to be effective, employees must work well in teams. They are replacing evaluations and rewards based on individual performance with evaluation and rewards based on group performance.
Assalamualaikum and good day to Dr. Danila. I am Arisa Suraya binti Zulfitri, matrix number 275535. As you can see on the screen now, I'll be presenting a subtopic pertaining to the critical success factors and key performance indicators. To begin with, I would like to give you an overview on the definition of the critical success factors. The critical success factors is defined as a key result areas, which are the areas of your business or project that are vital to its success. Critical success factors also help in identifying and communicating critical success factors within your organization, and it helps to ensure that your business or project is focused on its aims and objectives. Okay, moving on to the next slide. I am turning our attention now to the other definition of critical success factors, which is it can also be defined as a key area where satisfactory performance is required for the organization to achieve its goals, a means of identifying the tasks and requirements needed for success, and at the lowest level, critical success factors become concrete requirements. Last but not least, it is also a means to prioritize requirements. According to John F. Rocket in the Harvard Business Review says, critical success factors for any businesses are the limited number of areas in which results, if they are satisfactory, will ensure successful competitive performance of the organization. So now we come to the next point, which is the examples of critical success factors implemented in industries. For the first industry, we have life insurance industry. For this industry, the use of critical success factors is for the development of agency management personnel, effective control of clerical personnel, and innovative new policies. Next, we have automobile industry. In this industry, the critical success factors are used for styling and efficient dealer network organization and tight control of management costs. Other than that, we have food processing industry. The critical success factors are crucial in order to ensure the new product development are produced in good quality and good distribution channels and effective advertising. Finally, we have come to the last industry, which is the supermarket industry. The right product mix available in each store and having it actually available on the shelves, advertising it effectively to pull shoppers in, and pricing it correctly since profit margins were low in this industry is the reason why critical success factors are used in this industry. Okay, moving on to the next slide. For this slide, we will learn about the types of critical success factors. Basically, there are 4 types of critical success factors. The first type will be industry critical success factors resulting from the specific industry characteristic, followed by the strategy critical success factors resulting from the chosen competitive strategy of the business. Thirdly, we have environmental critical success factors resulting from economy or technological changes. Last but not least, temporal critical success factors resulting from internal organization needs and changes. As you are all well aware that things that are measured get done more often than things that are not measured. Alright, for the previous slide, we have looked at the types of the critical success factors. So for this slide, I would like to discuss in more depth about the application of critical success factors for a business organization context. Let me begin by explaining on one of the critical success factors, which is service. The product's tangible and intangible features promised to the customer is also known as service. Service is also known as a value in use. To add, how customers are treated before, during, and after purchase decisions are considered important as well. Next, I will focus on the second critical success factors, which is quality. It is believed that quality has to do with the difference between the promised and the realized level of service, also the conformance to the specifications. For example, Proton and Mercedes, they manufacture cars for different market segments and different product specifications. As long as both adhered to their specified standards, hence they are considered to achieve the quality in their market segment. The third critical success factors for the business organization would be cost. This is because resources are used to provide the product or the service. The aim is to produce with the least resources, hence increase the competitiveness. Finally, the customer is one of the critical success factors that is based on the customer's perspective. Furthermore, taking the value chain concept into perspective, the customer will be the most important determinant in the company's success. As we all know, a term about customer is always right. One way to identify the critical success factors is to go through a strategic planning process. A second approach is to conduct a competitive intelligence research, where organization needs to look at the success factors of your competitor. Collectively, an organization will need to develop a set of critical success factors which serves as the foundation for its performance measurement system. Consequently, critical success factors are an important link between the strategic plans and the performance measurement systems. Okay, for this slide, it relates to what I was saying earlier. I will be listing the example of critical success factors. Statistical research into critical success factors on organizations has shown there are 7 key areas which as follows: training and education, quality data and reporting, management commitment and customer satisfaction, staff orientation, role of the quality department, and communication to improve quality, and last but not least, a continuous improvement. Next, if you look at this chart, I think the chart perfectly shows the typical top success factors for projects, which were as follows. The chart is developed in decreasing order that portrays percentage factors responsible for success. Based on this chart, the percentage represent the success factors. From what we can observe here, the dominance of executive support as it plays an important role as critical factor for success. This is because it shows the highest value in percentage, which is 18%, followed by user involvement, which at 16%, for an experienced project manager as a third critical success factor, depicting 14% of impact. Nonetheless, the clear business objectives as critical success factor stands out 12% behind experienced project manager as a critical success factor. Eventually, what can be clearly seen in this chart is minimized scope as critical success factor falls at the lowest percentage, which is 10%. Okay, for this slide, I would like to change our direction and talk about key performance indicators. Key performance indicators refer to a set of quantifiable measurements used to measure the company's overall long-term performance. The key performance indicators specifically help to determine a company's strategic, financial, and operational achievements, especially compared to those of other businesses within the same sector of our company. Next, performance measurements are used to assess an organization's performance on its critical success factors. Thirdly, the measurements can be non-financial and subjective by nature. Okay, moving on to the next slide. I will be talking on the application of key performance indicators and critical success factors on selected industry. For example, hotel industry. The link between critical success factors and key performance indicators is that critical success factors, or known as CSF, are the cause for the success of the organization, and the KPIs are the effects of the actions that measures the successfulness of the actions. The KPIs help the company to track how things are going and monitor the company's performance. Back to our example of the application of KPIs and CSF on hotel industry, for example, the KPIs can help the hotel to assess the hotel's performance and measuring the achievement on the hotel's objective. The KPIs can help the managers to ensure hotels' resources are used in an effective and efficient way in order to achieve the objective, which is profit maximization through the stakeholders' satisfaction. To add, hotel management can use KPIs as a basis to analyze the current performance to predict future requirements and to improve hotel strategy for ongoing success. Okay, moving on to the next slide. For this slide, I will be explaining on the example of key performance indicators and critical success factors compared to one another for hotel industry. If the critical success factors is service, hence the KPI would be maintaining the star hotel rating, the customer's retention, and the ability to meet the customer requirement on time. Whereas if the critical success factors is quality, the KPI would be the number of complaints, the customer satisfaction surveys, and the employee's appearance and friendliness. And if the critical success factors, the concern is cost, hence the KPI would be the total room sales, the total revenue achieved, food and beverage sales, and sales growth and revenue per available per room. And if the critical success factors is customer, the KPI would be number of customers, number of new customers, and number of lost customers, and the market share.